That's right, folks. This is one that I called. I told you I was going to look beyond meat stock, but look, I knew it was going down after earnings. I think we could all see it happening, right? It was going to go down further. We're going to dig deep into these earnings today, find out what's going on with it. Why did it fall? My presumption is I did a little peeking. My presumption is, the growth's not there. So that is a good reason why you've seen the stock absolutely tank. And if we look from a long-term horizon, obviously nowhere near their 2019 highs, which was a ridiculous skyrocket, down really around 80% since then, and from its 52-week high, which you can see located here in July, down around 70%. So this thing's gone into the turlet, and that's obviously not accounting for the additional 10% downward movement. So over 70% down in the last year. Let's take a peek. It's falling into the trap that a lot of these overvalued companies did, that were newer companies that showed really strong growth in trendy areas, and they shot up to ridiculous valuations. They're not profitable ever, but it's wild. So let's take a look. And why did I peek? Look, I normally don't peek on this, but I peeked for this reason. I saw a GAAP EPS beat by $1.98, and I was like, "There's no way. They don't make money," and they don't. So this is actually a typo by Seeking Alpha because they suck. Mamtora. Look, you gotta learn what you're talking about here. This is a negative $1.27 line. Negative $1.27. They lost quite a bit of money this quarter, actually. Quite a bit. Especially as oh my gosh. Oh, we'll get into this, folks. But let's look at the revenue line. Look at this. This is despicable, in my opinion. $100.7 million. A decline year over year. You're going to tell me right now that this company, which was bolstered as a hyper-growth company, just declined year over year in terms of sales. It's despicable. I mean, it's despicable. There's a reason why this stock's down to where it is. This thing got way too big for its britches. And again, as I mentioned with stuff like Tattooed Chef, and I mentioned this in the earnings video that I had to get rid of because of the corrupted audio, this trend is just that. It's a trend, and I don't know where the long-term legs are for this type of trend. When we're talking about alternative meat products, these aren't health foods, right? These aren't health foods by any means. If you've seen any of the not only caloric information but sodium content from these partnerships that they've had with fast food chains, from the Burger King, I mean, every one of the Impossible Whopper, they are worse than the original burger. I get it. The premise is to not eat meat. I get it. But they're worse for you. It's worse for you, folks. And for that reason, I don't see the trend catching on as fast as I think people expected. And my perspective on it is I just think overall the market itself is a much smaller market than people are really anticipating. I don't think that this kind of stuff is going to turn people to 100% vegan. And there's a chance maybe every now and then people might take that or enjoy a nice alternative meat product. But look, it's just not it. And from the outlook, I don't know if I see this happening. 560 to 620 million, an increase of 21 to 33% year over year. I don't know if I see that happening because if you look at it this year, they only managed to grow 14% in the full year. But let's get into those highlights, okay? Net revenues, as we saw, disgusting. Net loss, that's right, $80.4 million. Can you make this up? $100 million in revenue, $80 million. 80%, their net loss as a percentage of revenues was 80%. What? How is that even possible? I don't even know how it's feasible for a company to lose that much money as a percentage of revenue. I don't know how it's feasible. Look, and I hate to bash it, but there's something terribly wrong with the management of this company if they could allow that to happen. I think that goes without saying. What's the chief financial officer doing in all this? What does he do? Does he get fired? Should get fired, probably, because that is disgusting. I mean, it's disgusting. I get not being profitable, but 80%? Negative 80%? Holy crap. For the full year, not necessarily as bad, but did post a net loss of $182 million. This quarter was horrific for it, by the way. I mean, and you can see it. They posted up $100 million of net loss through the other 3 quarters, but this quarter posted $80 million alone. Crazy. More than double the average prior. I mean, and the net loss as a percentage of revenue was at 39% for the year. Still disgusting, but much better than this quarter. And obviously this quarter dragged it down quite a bit. Very concerning. I don't know. Look, people are gonna be upset with that, but I don't know. Don't know what you want me to tell you. So let's look at some of the revenue by channel from a retail standpoint. This is a massive, massive concern. And there actually is really good reason for that. So in case you didn't remember, there was a little bit of a massive meat shortage in 2020. People were buying stuff like Beyond Burgers because it was the only thing that was in stock in the freezer section, right? So that's why this retail segment was so much bigger in 2020, and it shrank 20%, and it's not going to continue to grow. The only avenue for them to grow right now, in a meaningful way, I should say, is the food service, which did grow 34%. So, all things considered, that's not horrible. But again, I'm guessing they're accounting for a flat retail line for the year, which is despicable because it's their largest segment. But again, there's just such a low ceiling. I mean, I don't know if you can't see this, but I know I can see it. It's such a low ceiling. International retail did grow 10%. Nothing crazy, though. Small amount, obviously. Just a $1 million difference, which is nothing crazy. Cat just jumped in the window. Kind of wild. And for the food service, increased 36%, which is relatively consistent with the U.S. line. So international actually carried them, because if you look in the U.S., net revenues declined 8.8% year over year in the U.S. in their biggest market. That's just not good. It's just not good. That's the whole reason this company got to the valuations that it was at, was because of the fact that they were able to grow by multiple high double digits, and now they're declining revenue. I mean, that's just, it's despicable. In this market, that just, you can't survive like that. Just being honest. For the full year, disgusting. Retail down 7.9%. Food service was actually only at 25.9%, so this is a big quarter for them, but not good, all things considered. U.S. net revenue on the entire year, that's right, was down 1.6%. It's just disgusting. Good for them to expand, internationally, I get that, but you can't be declining in your largest segment already. You can't already show a decline. It looks already like they've reached the cap, right, in terms of U.S. numbers. That's what it looks like from the outside investor standpoint. And you see the only good potential prospect here is the food service segment. And again, it's a trend that, as I've mentioned before, I don't know if it sticks around from a food service standpoint. I don't know if it does. But yeah, that's that. I'm sorry, folks. I hate to be negative. We're going to look at the balance sheet, try to find some positivity, because I'm just bashing this thing, and you hate to bash a dog while it's down, But here I am doing it. So here's the balance sheet. Can we find some positivity? I have a feeling we might be able to. $1 billion in total current assets right now. Massive increase in the cash position. Not sure why they increased the cash position by so much, but it's curious. Inventory line did increase quite a large amount, as you've seen with really every company here as of late. Not a shocker. So total assets in general, really no long-term assets on this company, very minimal amount. And it's all in this property standpoint, really, so nothing crazy there. 1.3 compared to 468. The main growth obviously being in the current asset standpoint, so nothing crazy. From a liability standpoint, not too bad. Total current liabilities sitting at a good margin. Holy crap. Sorry, I just saw something that was shocking to me. Oh gosh, total current liabilities at 94 million compared to 88 million. So small amount of long term or short term liabilities. Pretty nice. I like to see that. Now this is a disgusting line. In the last year, they've raised $1.1 billion of capital through, oh gosh, through convertible senior notes. That's where a lot of the cash came from. We can tell that. That's just, I hate it. I just hate everything about it. I'm sorry. So shareholder equity. Now there is an equity on the balance sheet, so that's a positive, but it shrank massively, nearly 1/3 of what it was of just a year ago because of this massive convertible senior note line. Look, is there anything positive I can say about Beyond Meat stock? Well, market cap now is going to be trading at pretty cheap valuations, right? You consider it trading under a $3 billion market cap. Now, annualized revenue, obviously not quite there. Right around 500 million in annualized revenue. Not incredibly exciting. Sorry, I meant 464 million in net revenue. So it's not. It's still overpriced for today's market. This is through a 70% drop in the share price in the last year, and it's still at a price to sales of 5 times. I just can't believe this is a stock that's valued still as highly as it is. That's my opinion on it. Look, I get it. People are going to hate on this. I just think this thing is, the company's not run well. It's a trend that is not, it's not going to stick as hard as they want it to. It's going to stay around, but it's not going to hit a massive surge like I think people were predicting. And I think you kind of saw that this year. So that's what I got for you. I hope you have a good day.